David Jaffe with BestStockStrategy.com. Go to BestStockStrategy.com, enter your email address, and receive $400 worth of free training. In this video, we're going to discuss why it's important to bend but not break if you want to be a successful options trader. Again, why it's really important to bend but not break. In September and October of 2018, we have realized some relatively large paper losses on our positions. For example, Facebook was trading at around 172, 175, and it fell all the way down to around 156, 157. And actually earlier this year, it fell further than that. Alibaba just last week was trading at around $162, and now it's trading at around 148. When you have these really large decreases in the stock prices from these very large companies, Facebook is like a $500 billion company, Alibaba is around a $400 billion company, it creates large paper losses in your account. Now, I still believe in these positions, and actually a lot of these positions, I still have strike prices that are below the current market price. So I still have puts on Facebook with a strike price of 150, but because the price of Facebook and the underlying stock has fallen so much, it's still showing me a large loss, and I have to wait for more time to come off of that specific option in order for that option to get back into a profitability. So right now it's showing me a paper loss, even though it's still around $5 or $6 above even though Facebook is trading around $5 or $6 above the strike price. But because it's fallen so quickly in such a short amount of time, then I'm showing a paper loss in my account on that specific position. But with time, as long as Facebook stabilizes and it doesn't approach the strike price, and the same thing with Alibaba, those positions are eventually going to show me a profit. But the reason why it's so important to bend and not break is that if you sold too many contracts, then you would be forced to close out those positions for a loss. And I can't tell the future. Maybe Facebook is going to trade down to like 140, or maybe Alibaba is going to trade down to like 130. I don't know. But what I do know is that by bending and not breaking, by managing those positions with 100% certainty, those positions will eventually become profitable to me. But if I'm forced to close out the position because I traded too many contracts, if I chose a strike price that's too aggressive because I wanted to maximize the amount of premium that I received without taking into account the perceived risk of that potential position, then I would potentially be forced to close out that position because I would be placed in a margin call from the precipitous drop from Facebook and Alibaba, and I would not even have the opportunity to partake in the gains of those positions, even though I might be right when I initially made that trade when Facebook and Alibaba rebounds. So again, when you trade too aggressively, when you trade too many contracts, you are very likely to get hit with a margin call when a trade goes outside of the expected return and when a trade doesn't go your way. So when Facebook was trading at around 172 and then it fell down to around 160, you could sell the 148 put on Facebook, or when Alibaba just last week was trading around 165, you could trade, or 162, you could trade that 145 put on Alibaba and have it be profitable with like a 95% probability. But guess what? Alibaba right now is trading at around 148. So if you sold that 145 put, instead of having a like $15 of cushion, $15 of $15 to between the current market price and the strike price selection, now you only have 3. So many people, they're not even that safe in choosing and selecting their strike price. Instead, what they do is Alibaba would trade at 160, they would then trade a 155 put and realize that because they would want to maximize the amount of credit that they receive, now Alibaba is trading at 147, they're in a margin call and they don't even have the opportunity to roll and manage that position. They would then close that position out at a loss, only to watch Alibaba trade back up to 160 in like a week or two. So even though their original premise was correct, they are not able to partake in the appreciation of the underlying stock, because we all know that stocks, they go up too much and then they go down too much, and then they tend to retrace their gains and they retrace their losses, so things tend to normalize. But if you trade too many contracts, then you are not going to be able to partake in the normalization of the price action, because your broker is going to force you to close out that position at a loss. So that's why I'm saying that you should make sure that your safety net is relatively far away from the current market price. For example, when Amazon traded down to like $15.50, I sold a put with a strike price of, when Amazon was trading at around $18.50, I traded and sold a put on Amazon with a strike price of $15.80. Could I have received a lot more credit by selling a strike price of $1,700? Yeah, of course, but I also don't want to deal with managing and rolling a position, and I also don't want to deal with the stress of checking my account all the time. So I would much rather go for a high probability of profit, sell the $15.80. That way Amazon has to fall an incremental 10% for me to even start getting worried about that position. So let the market beat you. Bend, but don't break. This is David Jaffe with BestStockStrategy.com. Go to BestStockStrategy.com, enter in your email, and receive $400 worth of free training materials. And if you have any questions, let me know. Please like, comment, share, subscribe to this channel. It helps me get the word out, and it helps other people become profitable.